Hey everyone, and welcome back to my channel where we discuss everything related to investing. The PCE data came out this week. Unfortunately, the latest PCE isn't ideal. The core PCE inflation index shows that US inflation pressures remain high, which means that the Federal Reserve will most likely continue to raise interest rates and maintain a high interest rate policy for a while longer. Moreover, PCE data shows that as prices rise, consumer spending growth has exceeded expectations. In January, it increased by 1.8%, which is higher than the expected 1.4%. Real PCE, which is inflation adjusted, rose by 1.1%. At the same time, personal income growth adjusted for inflation also increased by 1.4%, higher than the expected 1.2%. Finally, the personal savings rate also increased to 4.7%. All of this data indicates that inflation is accelerating at the start of the new year and is likely to lead to the Federal Reserve increasing their interest rates further and faster, which is not good for the stock market. The PCE index is more closely watched by the Federal Reserve than other indices like CPI inflation, primarily because it is adjusted depending on consumer purchase patterns. For example, many consumers now use lower-priced goods to replace higher-priced goods, which can provide a more accurate understanding of the cost of living. Moreover, the Federal Reserve is more likely to focus on core inflation excluding food and energy, as they believe that core inflation provides a better long-term view of inflation. However, we're not going to focus on PCE data in this video. There are two macroeconomic data releases recently, which surprisingly have not received widespread media coverage. The first data release was on February 16 when the Philadelphia Fed released its February manufacturing survey. The market's median expectation was a drop of 7.8, but the final data showed a decline of 24.3. The Philadelphia Fed's manufacturing survey may be unfamiliar to many people. It is a survey of local manufacturers that provides participants with data on changes in overall business activity and various activity metrics at their factories, including employment, working hours, new orders, unfilled orders, shipments, inventories, delivery times, prices paid, and prices received, among others. The survey has been conducted monthly since May 1968, and it is the oldest report among the 12 Federal Reserve banks. It is generally considered to accurately reflect the growth rate of the national manufacturing sector. When this index is above zero, it indicates that manufacturing is expanding, while a negative value indicates that the economy is contracting. Due to the more than 50 years of data, this index provides reliable early signs of whether the economy may be entering a recession. The Philadelphia Fed has always claimed that its survey leads other indicators by several weeks and is closely related to lagging indicators such as employment and industrial production. In other words, it has a strong predictive ability, especially when other data still shows a strong economy, providing more accurate predictions. Besides, the U.S. economy is likely to approach a recession because of the leading economic index released on February 17. The leading economic index is a composite index published by the Conference Board, a nonprofit research organization. The LEI is designed to provide a forward-looking view of the economy by tracking a variety of economic indicators that tend to lead changes in overall economic activity. The LEI declined by 0.8% in December and again by 0.3% in January. Moreover, the US LEI is still in a downward trend, but the rate of decline slowed slightly in January. In addition, the yield curve of LEI has also turned negative in the past 2 months, which is usually a signal that an economic recession is coming. Although the LEI continues to predict an economic recession in the near future, labor market-related indicators including employment and personal income still remain strong. Nevertheless, the Conference Board still predicts that high inflation, rising interest rates, and shrinking consumer spending will plunge the U.S. economy into a recession in 2023. In summary, According to their analysis, it is expected that the US will experience an economic recession this year, and we can see that the red line is a forewarning of the impending economic recession. It is already below this position, and when we look back at history since 2000, every time this data fell below this position, it was accompanied by an economic recession. In summary, all signs point to a high probability of an economic recession coming this year, rather than the soft landing that many people expect or even the market consensus. Of course, sharing this information is not intended to cause fear or panic, but rather to prepare for what may happen. If you have other opinions, let's comment below. Please help to like and subscribe.